Hello everybody, thank you for joining me for this video. My name is Nick Strobelt with Avalon Wealth. The title of today's video is Brief Economic and Market Update. I want to stay true to the title and have this be as brief as possible. So hopefully there's some nuggets, information you all can take from this. I've been able to talk to a lot of you over Zoom calls, phone calls, some in person, not as much as before COVID, of course. But I hope it's very difficult sometimes to give this information over the phone. So hopefully this will be helpful to many of you. A lot of folks I've heard about recently are concerned or have asked me questions about inflation. If it's as bad as we hear about on the news or what's really going on with it. So I want to touch on a few things regarding inflation and other things that are moving the markets. Not only inflation, but what's going on in Washington right now. There's a massive spending bill that's being negotiated at the moment, $1.75 trillion. And really, how does that work with inflation? The Federal Reserve tapering, which is a topic that I'm watching very closely. Also, a very brief look at what's going on in the markets. And so let's just dive right in. Regarding inflation, this is a quote I saw recently that I liked. Inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair. So I'm going to dedicate that to all the men that are balding around the world. But anyway, inflation is on all seriousness, it's a big concern for many. Anyone that has money in the bank account, when we hear about inflation at 4, 5, 6%, we can feel our purchasing power being lessened every single moment. And it's no fun. And so let's just look and dive into inflation a little bit further and see how bad it is and what is likely to happen. One of the people I follow very closely, his name is Jeffrey Gundlach. He's with Double Line Capital. He's considered the bond king. I followed him for many years. He has hundreds of billions of dollars at his discretion, management for bonds. His prediction is that inflation is going to stay at 4% or more throughout the end of 2022. And I take his insights with some seriousness, and there's a lot of evidence to back that up. Another quote on the bottom from the Fed chair. He said very recently, just a few days ago, our baseline expectation is that the supply chain bottlenecks and shortages will persist well into next year and elevated inflation as well. As the pandemic supply chain bottlenecks will abate and growth will move up, and as that happens, inflation will decline from today's elevated levels. So he mentioned one of the main reasons for inflation right now is the bottlenecks that are happening from the supply chain. One of those bottlenecks being it's very difficult to get products into the United States right now. In fact, let's just jump to the next slide. It's interesting, there's been a lot of photos being taken out of California showing the massive amount of ships, cargo ships coming from overseas that are just sitting in the harbor. This Yahoo News report said that there were 70 ships outside just waiting their turn for their cargo to be unloaded. Now, there's a lot of finger pointing going on right now as to the cause of why it's taking so long. For a time they were saying there weren't enough truckers to haul it out. There's also a lot of evidence saying that because of COVID restrictions, there aren't really enough people manning the ports to unload all the cargo. And so there's multiple problems going on that's causing this bottleneck. But this reporter from Yahoo, they figured out the containers on more than 70 ships anchored off Los Angeles would stretch from Southern California to Chicago if laid end to end. Which is kind of interesting to think of it that way. That's how much cargo is sitting outside of California right now, and really, I think it's closer to 100 cargo ships sitting out there. So there's a lot of different causes of inflation. So this is a supply chain inflation, meaning that because there's fewer products, but there's the same amount of money chasing those products, the cost of those products goes up. And so it's a supply chain problem that is mainly causing the inflation. So what is the inflation right now? So as of a couple days ago, the most recent inflation data came out, being 5.4% is the rate, is the cost going up on average. Now, that's been higher than what we've seen over the last several years, where it's hovered more closely to 2%. So doubling to 5.4 is something that's very noticeable. And we probably have noticed it when we've gone to grocery shopping, or heaven forbid we had to buy a car right now, because cars are so expensive, and I'll touch on that in a moment. But looking back on the second chart below, we can see a history of inflation that puts it in more perspective. Of course, 5.4% is small relative to where it's been in the past. I am sure some of you remember getting a mortgage in the 80s when your mortgage rate was 10, 12, or even 15%. Nowadays, that would be an outrageous number to have for your mortgage. But fortunately, it's been a lot lower over the last 10 or so years. So when we think of inflation at 5.4%, everything didn't go up just 5.4%. That is the average. And it's important to look at how they calculate the 5.4%. How do they calculate the average? Because certain categories get larger weights than other categories. So this next slide shows how they weight the calculation of inflation. Now, this is a little bit nerdy, I apologize, but I like it, and I think some of you may like it as well. So this is the Consumer Price Index showing how they weight it. So housing at 36%, transportation at 15%, medical care 8%, food and beverages 15%. So one of the categories, let's talk about transportation for a moment. We've all heard going to get a used car or a new car is so expensive right now. And again, because of the supply chains, often new cars, or they all need microchips because they're so sophisticated these days, but the microchips are in such short supply that there are trucks and cars 99.9% built, but they're just waiting on those microchips to arrive to be plugged in, then they can be shipped to the lots. So we're just waiting on those chips, and we can't get them. And so used cars, which already have the chips, are available, but they're in such high demand that the prices are skyrocketing. So used cars of this section only represent maybe a small sliver of the 15%. But it's interesting, on the next slide, we can see used car prices over the last 12 months have jumped 24%. So anyone who's buying a used vehicle has experienced much more inflation than the person that's keeping their existing vehicle alive for a few more years. So it really depends on someone's lifestyle, if they're experiencing inflation in the worst or the best way. So looking at this, used cars up 24%, energy over the last 12 months is up 25%, food up 4.5%. So this is grocery store food in my example here. So food eaten at home. Now mainly it's because of the meats that have gone up in price. Pork, beef, chicken, all those things have skyrocketed, and whereas everything else has stayed relatively flat for the time being, which has caused food to go up. So if we didn't buy a car, if we're consuming the same type of food, and if we're vegetarians, we're going to experience less inflation than someone not doing those things. But overall, when we consider all the categories, it's up about 5.4%. So, but the good news is with inflation is that a lot of it is because of the shortness of supplies on the microchips, on the cargo ships coming in the United States. And so because of those things, it's predicted, like Jeffrey Gundlach said, that over the next 12 to 18 months, the supply chain bottlenecks will be resolved as the more employees come to help all those situations. And so it's likely the inflation pressure coming from a shortness of supply, that will go away. It's just a little bit of time before that happens. And so it does seem transitory and not permanent, which is good news. So we have to stick it through for the next 12 to 18 months. And that's a positive insight to look at. Another subject I want to briefly touch on is the spending bill that's taking place. Let's just look really quickly what's in it. Of course, it's not passed yet. They're still negotiating, but if it does get passed in its current state, this is what it might look like. This is what we have. Mainly, a big portion of it, 555 billion of the 1.75 trillion, will be in clean energy initiatives, and mainly that is in tax cuts for doing energy saving actions. So if you get solar panels on your roof, you get a tax break. If you buy a new electric vehicle, you get a big tax break. And so those tax breaks, of course, cost a lot of money, and that's what the government is trying to incentivize by putting this in the bill, is to encourage people to do that more and more over the years. Other big pieces of it real quick, just to touch on, preschool for ages 3 and 4 year olds, funded for 6 years, subsidized childcare, paid for a number of years, 1 year extension of the current expanded child tax credit, expanded tax credits, clean energy and electric cars that we discussed, extend some of the Affordable Care Act subsidies for 4 years. And so a lot of what's in it is extension of the help that the government created during COVID, just making that last longer. And then one of the interesting things, I like this picture because it gives you a scale of how much is going where. This little piece down here in blue is Medicare hearing. So my clients who I help with the most, that's most likely how they're going to see any benefit from this is getting hearing aids through Medicare. Child tax credits are probably going to help and all those things. Maybe some clean energy might, but Medicare might be the only source that many of you might benefit from this big bill. But the massive question is, how are they going to pay for it? How is this bill going to be funded? And anytime I talk about how they tax people and income taxes, I always think of Albert Einstein. The hardest thing to understand in the world is the income tax. And I believe it, because even when I speak to CPAs and I ask them a question, a lot of them have to get back to me on the answer. And so I think even the most experienced folks have to double check, and it's not clear as day to many of them. But anyhow, how they predict and expect to fund this is some believe it's 100% funded by these initiatives. So let's take a look at them. A new 15% corporate tax, minimum tax on large corporations, and so that will be expanded pretty soon. Tax targeting companies that perform stock buybacks. So often a company, if they perceive their stock is trading at a low value, they will use their own cash in their account to buy their own stock back. And so this is going to penalize them in a way for doing that, make them pay tax for doing that. New tax surcharge targeting the wealthiest Americans. So anyone that makes $10 million a year or more is going to pay an additional 5% on their earnings. If you make 25 million or more, then an extra 3% on top of that will be applied to you. And so they're really trying to market this as the wealthy are going to be paying the majority of this burden. Now, time will tell if these adjustments will actually pay for the $1.75 trillion. It's very debatable. There's people on both sides saying it will and it won't, so time will tell. But one of the last things I thought was interesting that they're doing is they want to give $400 billion to the IRS to empower them to pursue those that have extensive loopholes in the tax system. So again, targeting the wealthy that are using the IRS code in their benefit is to kind of stop them from abusing loopholes. And so in theory, that sounds good. $400 billion to allow that seems pretty excessive, but that's how it currently stands. And so we'll see how that goes. Another section I want to talk about very briefly is the Federal Reserve tapering. The Federal Reserve balance sheet has been in the news recently because they've made an adjustment or a news announcement over the last couple of days. First of all, what is the Federal Reserve balance sheet? It's very different from the national debt that is in the news quite often, at $29 trillion. This is not that. The balance sheet is a separate department of the government that is able to manipulate interest rates. So they control what the short-term interest rate is, and then they have tools to manipulate the long-term interest rates. And so they can essentially create zeros in their bank account and create this money and then buy U.S. Treasury bonds, mortgage-backed securities, to push long-term rates down so that they become more affordable for people that want to get long-term loans or mortgage loans. So that's how they do the long-term interest rates. Back before 2008, before the financial crisis, their balance sheet was roughly $1 trillion, and it had stayed like that for quite a long time. But 2008, the financial crisis, they began to create a lot of money to stimulate the economy by purchasing bonds, longer-term notes, controlling and manipulating interest rates everywhere they could, as well as using money to directly invest into banks, directly invest into too big to fail corporations to provide stability, the perception of stability. And so the balance sheet jumped from $1 trillion to over $2 trillion pretty quickly. And then since 2008, it's been steadily going up all the way until about 2016. And when they began at that point reducing the size of the balance sheet, and they call that tapering. So they began to taper in 18, 19, and then COVID happens in 2020, and mass emergencies happen, and they begin to stimulate the economy at unprecedented levels. And so the Federal Reserve created money in their account and stimulated the economy by buying bonds, pushing interest rates lower, mortgage rates lower to stimulate the economy. And it jumped from $4 trillion to $7 trillion pretty quickly. And now it's continuing to increase to $8.5 trillion. So this has been a trend ever since 2020. And as of a couple of days ago, what happened was the Fed chair announced that they're going to begin tapering again, or reducing the size of the Fed balance sheet. And what that signals to the economy and the markets is that they're going to start reducing pushing longer-term interest rates lower at the same pace or level that they're currently at. And so longer-term interest rates over time will have less pressure from the Federal Reserve pushing them lower. And they likely might be doing this for many reasons. One, the economy is been on the up and up recently, but they also want to combat inflation probably a little bit by making that move. So this is what the Fed's doing. It's moving markets. This is something I'm thinking about, and it is interesting to mention a part of this brief update. And then finally, I want to touch on the broad markets, the stock market, the bond market. This is showing just a 6-month history of the S&P 500 here in the dark blue but skinny line, and then bonds in the lighter blue thicker line. So over the last 6 months, bonds have been pretty flat, growing just 0.1%. Stocks have grown better. In September, they were up 8%. Then they took a dive, and then they rebounded back over the last several weeks to about 11% over the last 6 months. Those of you who have watched me over the last several years or met with me know my analogy I like quite a lot, which is the owner and a dog on a leash. Now the dog on the leash is attached to the owner, and it can't go too far away from the owner because of that leash. But the dog is very distracted. It gets any shiny object or anything that looks exciting, it'll run after it. That's what the stock market is. It's like a dog that's on a leash. It gets excited by headlines. It gets scared by headlines. It will move up and down based on any kind of news that's out there. A lot of knee-jerk reactions are taking place. But because it's attached to the owner on the leash, it can't go too far from the fundamentals, which is what the owner is. The owner is the economy. It's GDP, it's the employment rate, it's the inflation rate, it's growth, wages. All those fundamentals are in there. So if the fundamentals are good, the economy, the stock market can't deviate too far off from the direction that the economy is going. So any knee-jerk reactions that are happening over the last several weeks or months are just, in my opinion, distractions and shiny objects that the markets are being distracted by. So it's impossible to know what the market's going to do in the short run, but it's good to have that insight as we watch it on a day-to-day basis. But anyway, kind of tying this all together, it's interesting when we consider inflation and when we consider our accounts, when we consider our savings and reserve accounts. It's always good to have a reserve in checking or savings where you have immediate access to for emergencies. But sometimes out of fear, we have excessive reserves personally, where we have a lot of money that is sitting there. And a lot of folks call that dumb money. And they call it that for a couple of reasons, or for one main reason, which is it is just being burned by inflation. It's just sitting there, it's not growing, it's losing its purchasing power on a daily basis. And it's excessive to what we need for an emergency. And the main reason people do that is because looking at the stock market and there's a lot of risk potentially, and there's fear that we don't want to lose it. And so the question is where's a safe place to go when we want to keep it conservative, but we don't want to lose money to inflation. And those of you who've watched my videos in the past, my 3 investment spaces, it's on my website if you like to go there. There's many other options of where to put money that wants to stay conservative but have better opportunities at getting interest that are better than the bank or oftentimes CDs, things like that. So it's often worth a conversation if it's been bothering you that you're losing money due to inflation in your checking account. Feel free to reach out to me, email me, call me, whatever it might be, and I'd love to help. But in any event, here's of course some disclosures that I'm required to show you. If you want to read them, pause the video and look through it. But I appreciate all of you so very much. I appreciate the opportunity to serve any way I can. If you want to call or email me, if you have questions about your individual accounts, I'm here to help. I know it's been, some of you I've met with recently, some not as recently due to COVID and some personal restrictions, but I'm able to meet in person or through phone call or Zoom, whatever's easiest for you. I look forward to being in contact. Please give me a call if I can be of assistance. Thanks so much, and until next time.